There is a price for every lesson the market teaches. For most, that price is paid in cash, in lost sleep, and in years of wasted time. We learn about risk by being ruined. We learn about bubbles by being burned. We learn about bad management by watching our hard-earned capital evaporate under their command. Each lesson is carved into our account balance, a scar left by the tuition of trial and error. But what if there were another way? What if you could acquire the wisdom of a lifetime of market cycles without paying that brutal price? What if you could download decades of experience directly into your decision-making process, sidestepping the landmines that have blown up countless investors before you? This is not a fantasy. It is the core operating system of the single greatest investor in history. Warren Buffett did not become the Oracle of Omaha by inventing a secret formula or a complex algorithm. He built a 9-figure fortune, then a 10-figure fortune, and then an 11-figure fortune, on a principle so simple it seems almost insulting. The most effective way to succeed is to systematically and obsessively study the successes, and more importantly, the failures of others. He decided early on that while his own mistakes were good teachers, the mistakes of others were far, far cheaper. He built his empire by standing on a mountain of case studies, a library of business history that served as his personal flight simulator for the world of capital allocation. This is his final promise, the ultimate inheritance he offers to any retail investor, any entrepreneur, any student of the game willing to listen. Stop paying the market for your education. The lessons have already been paid for, in blood and treasure, by generations who came before. Your task is not to blaze a new trail through a dangerous wilderness. Your task is to find the map, to study the map, and to internalize the map so deeply that you can navigate the terrain with the confidence of someone who has seen it all before. Today, we deconstruct that map. We are going to install the 5 pillars of this learning methodology, this system, for stealing decades of experience, so that you can begin your own journey toward financial freedom, not by guessing but by knowing. The first pillar, the very foundation upon which this entire intellectual fortress is built, is the radical commitment to what Buffett calls the inner scorecard. Before you can ever hope to learn from the wisdom of others, you must first build a stable, internal framework for judgment. You must decide whether you are playing a game where your success is measured by the applause of the crowd or by the quiet, internal satisfaction of a process well executed. This is the great fork in the road for every investor. The path you choose will determine everything that follows. Without a robust inner scorecard, the lessons of others become just more noise, more conflicting opinions in the howling gale of market sentiment. With it, their experiences become data points, sharpening your own unshakable view of reality. The foundational anecdote for this principle isn't found in a flashy trade or a billion-dollar acquisition. It's found in the quiet, carefully crafted documents of his earliest days, in the promises he made to a small group of family and friends in Omaha, Nebraska, long before the world knew his name. In 1956, at the age of 25, Warren Buffett started his first investment partnership, Buffett Associates Limited. He raised $105,000 from 7 partners, but he didn't do it the way anyone else on Wall Street did. From the very beginning, he engineered the entire structure to force both himself and his investors to rely on an inner scorecard. First, he outlined the ground rules in a letter that has since become legendary. He told them he would not tell them what he was buying or selling. Think about that. He was asking for their life savings and telling them they would have zero visibility into the day-to-day operations. He was severing the link to the outer scorecard of popular opinion. They couldn't go to a cocktail party and brag about owning the hot stock of the moment because they wouldn't know what it was. They couldn't panic and call him when a stock he owned was plunging because its identity was a secret. He was forcing them to judge him on one metric and one metric alone: long-term results. His second rule was even more radical. He told them that he would only measure his performance against the Dow Jones Industrial Average, and that the only meaningful comparison would be over a period of at least 3 years. He was explicitly telling them not to judge him on a monthly or even a yearly basis. He wrote, "I am not in the business of predicting the general stock market or business fluctuations. If you think I can do this, or think it is essential to an investment program, you should not be in the partnership." He was building a fortress against short-termism. The outer scorecard screams at you every single day. It's the ticker tape, the cable news chyron, the talking head predicting a crash, the neighbor who just doubled his money on a tech stock. Buffett knew that to do his best work, to practice the deep, patient, value-oriented investing he had learned from his mentor Benjamin Graham, he had to be deaf to that noise. He had to operate in a quiet space, governed only by his own analysis and his own conviction. He was playing a different game, and he needed his partners to be on the same page. His fee structure reinforced this. He took no salary. He only got paid if he delivered returns above a 6% annual hurdle. And even then, he only took a quarter of the profits above that level. His financial success was directly and inextricably linked to the long-term success of his partners. He was aligning his incentives not with Wall Street's culture of activity and fees, but with his partners' goal of actual wealth creation. This entire structure was a masterclass in behavioral psychology. By setting these terms, Buffett wasn't just managing money, he was managing expectations. He was training his clients and reinforcing for himself that the only thing that mattered was the steady, rational execution of a sound investment strategy over time. The opinion of the crowd was not just irrelevant, it was a toxic distraction. He lived by his results, measured over years, against a clear benchmark. That was his inner scorecard. And by refusing to provide the daily fodder for the outer scorecard, he ensured he could do the work required to produce those results, free from the emotional roller coaster that derails 99% of market participants. The psychological principle underpinning this entire philosophy is a battle against one of the most powerful forces in human nature, the drive for social proof, and the resulting herd mentality. Our brains are ancient machines, designed for survival on the savannah, not for navigating the complexities of the modern stock market. For hundreds of thousands of years, our survival depended on our ability to stick with the tribe. If everyone in your group suddenly started running, you didn't stop to do a detailed analysis of the threat. You ran. To question the group was to risk being left behind, exposed, and eaten. This instinct is burned into our deepest neural pathways. We are wired to believe that if a lot of people are doing something, it must be the right thing to do. This is the cognitive bias known as social proof. The psychologist Solomon Asch demonstrated its power in a series of famous experiments in the 1950s. He would put a test subject in a room with a group of actors and show them a line. He would then show them 3 other lines and ask them to identify which of the 3 was the same length as the first. The answer was always obvious. But then, the actors, one by one, would deliberately choose the wrong line. By the time it was the subject's turn, an enormous psychological pressure had been created. A stunning 75% of participants conformed to the group's incorrect answer at least once. They would override the clear evidence of their own eyes to avoid the discomfort of disagreeing with the crowd. This is exactly what happens in the stock market. The outer scorecard is the Asch conformity experiment on a global scale. A stock starts rising. The media starts talking about it. Your friends start buying it. The social proof becomes overwhelming. Your ancient brain starts screaming, "Everyone is running toward this thing. If I don't run too, I'll be left behind." This is the fear of missing out, or FOMO, and it is the engine of every speculative bubble in history, from Dutch tulips to dot-com stocks to cryptocurrency manias. Buffett's inner scorecard is a conscious, deliberate, and lifelong rebellion against this instinct. It is the construction of a cognitive firewall. It is the practice of saying, "I have done the work, I have run the numbers, I have assessed the long-term business prospects. The evidence of my own analysis tells me this is the correct course of action, even if every single person in the room is screaming that I am wrong." This requires immense psychological fortitude. It requires valuing your own rational judgment above the validation of the crowd. It is a lonely path. but it is the only path that leads to superior long-term returns, because the crowd is, by definition, average. And the crowd is most wrong at the moments of maximum opportunity, the depths of a bear market, when fear is rampant, and at the moments of maximum risk, the peak of a bull market, when greed is universal. The inner scorecard allows you to buy when others are panicking, and sell when others are euphoric, the very heart of value investing. It is not a financial strategy, it is a psychological discipline of the highest order. So how do we translate this powerful but abstract concept into a practical tool? We build an applied mental model, a blueprint that you can use to construct your own inner scorecard. This isn't just a thought exercise, it's about creating a physical document, your personal investment policy statement, or IPS. This document will serve as your constitution, your anchor in the storm of market emotion. Step 1 is to rigorously define your circle of competence. You must, in writing, answer the question, what industries and business models do I truly understand? Be brutally honest. Do you understand banking, insurance, software as a service, medical devices? If you can't explain how a business makes money, what its key drivers are, and what its competitive landscape looks like, it is outside your circle. Write down what's in, and just as importantly, write down what's out. This simple act prevents you from being tempted by a hot story in an industry you know nothing about. Step 2 is to establish your core valuation metrics. You need to decide, in advance, how you will determine if a business is cheap or expensive. Will you use a discounted cash flow model? Will you focus on owner earnings, as Buffett does? Will you look for a price-to-earnings ratio below a certain number, or a price-to-book value like early Graham disciples? There is no single right answer, but you must choose your tools. Write them down. I will only buy a business if I can purchase it for less than 15 times its average 3-year owner earnings. This creates a non-negotiable rule that protects you from paying foolish prices in a hype-driven market. Step 3 is to write down your thou shalt not rules. This is where you directly apply the principle of learning from others. Create a list of the specific mistakes that you have seen devastate other investors, and vow never to repeat them. For example, I shall not buy a business with a weak balance sheet and high debt. I shall not invest in a commodity business with no sustainable competitive advantage. I shall not average down on a losing position unless my original investment thesis is revalidated and remains fully intact. These rules should be born from the study of failure we will discuss later. They are the guardrails on your investment highway. Step 4 is to define your measurement of success and your time frame. This is where you explicitly reject the outer scorecard. Your IPS should state, my goal is to achieve an annualized return that exceeds the S&P 500 index by 2 percentage points, measured on a rolling 5-year basis. Short-term fluctuations are irrelevant to the success of this strategy. By putting this in writing, you give yourself permission to ignore the noise. You have defined the game you are playing on your terms. This investment policy statement is now your inner scorecard, made tangible. When you are tempted to chase a hot stock, you read it. When you are scared during a market crash, you read it. It is your pre-commitment to rational behavior. It is the machine you build to protect yourself from your own worst instincts. To truly appreciate the power of this approach, we must examine its antithesis, the path of the 99%. This is the path of the individual who lives and dies by the outer scorecard. Imagine the typical retail investor. Their morning starts not with a cup of coffee and a company's annual report, but with a frantic check of their brokerage app. The screen flashes green. A jolt of dopamine hits. They feel like a genius. The screen flashes red. A surge of cortisol, the stress hormone, floods their system. They feel like a fool. Their emotional state for the entire day is held hostage by the meaningless, random walk of short-term price movements. Their research consists of scrolling through social media, looking for stock tickers with rocket emojis next to them. They hear a rumor on a message board about a short squeeze and pile in, buying a company they know nothing about at a valuation that makes no logical sense. They are not investing in a business, they are buying a lottery ticket. They are a leaf in the wind, pushed around by the currents of greed and fear. Let's take the very real case study of the meme stock craze in early 2021. Millions of investors operating purely on an outer scorecard fueled by social media hype piled into stocks like GameStop and AMC. Their measure of success was not the underlying value of the video game retailer or the movie theater chain. It was the approval of the online crowd, the number of likes on their posts showing their gains, the feeling of being part of a movement. They were playing a game of social validation. For a brief, shining moment, they felt invincible as the stock soared to astronomical heights. But because their decisions were untethered from any internal logical framework, any analysis of revenues, profits, or long-term business prospects, they had no way of knowing when to sell. There was no inner scorecard to consult. There was only the roar of the crowd. And when the music stopped, and the prices inevitably collapsed back to earth, the vast majority were left holding the bag. They lost catastrophic amounts of money. They didn't just lose capital, they lost confidence. Many were wiped out completely, vowing never to return to the market. This is the predictable, tragic endpoint of a life lived by the outer scorecard. It turns investing into a gambling addiction, a desperate chase for the next hit of validation, and it almost always ends in financial ruin. It is a path of high stress, high turnover, and ultimately high failure. The financial connection here is profound and direct. Adopting an inner scorecard isn't just a psychological trick to make you feel better. It is a ruthlessly effective strategy for wealth creation. Its impact on your balance sheet is quantifiable and massive, primarily through three mechanisms. The first is the dramatic reduction of transaction costs. The outer scorecard investor is a hyperactive trader, constantly buying and selling based on news and sentiment. Each trade incurs a cost, whether it's a direct commission or the indirect cost of the bid-ask spread. These small costs act like a swarm of piranhas, eating away at your returns over time. The inner scorecard investor, by contrast, is a business owner. They buy great companies and plan to hold them for years, if not decades. Their turnover is incredibly low, meaning transaction costs become a negligible drag on their portfolio growth. The second and far more powerful mechanism is the minimization of taxes. In the United States and most other countries, there is a significant difference between short-term and long-term capital gains tax rates. A trader who holds a stock for less than a year and sells for a profit will pay taxes at their ordinary income tax rate, which can be as high as 37% at the federal level, plus state taxes. An investor who holds a stock for more than a year pays the much lower long-term capital gains rate, typically 15 or 20%. The inner scorecard investor, by their very nature, is a long-term holder. This tax differential is enormous. Imagine two investors who both generate a 20% return. The short-term trader might give up nearly half of it to taxes, while the long-term investor keeps almost all of it. But the most powerful financial benefit is the unleashing of uninterrupted compounding. When you sell a winning investment, you don't just pay taxes, you interrupt the magic of compounding. By holding on to a wonderful business, you are allowing your investment to grow on a larger and larger base, year after year, in a tax-deferred state. Let's quantify this. Imagine two investors, Alex and Ben. They both start with $100,000 and earn a 12% annual return for 30 years. Alex is a trader, living by the outer scorecard. He sells his winners each year, pays a 35% short-term capital gains tax, and reinvests the rest. Ben is an investor with an inner scorecard. He buys a great business and holds it for the entire 30 years, letting it compound tax-deferred. At the end of 30 years, Alex, the trader, would have approximately $975,000, a handsome sum. But Ben, the long-term holder, would have over $2.9 million, and that's before Ben even pays his lower, long-term capital gains tax upon selling. The difference is nearly $2 million. It's not because Ben was a better stock picker, it's because he had a better philosophy. He understood that the real engine of wealth management is not frenetic activity, but patient, tax-efficient compounding. That is the direct, tangible, life-changing financial power of building and trusting your inner scorecard. The second pillar of Buffett's learning system is the creation of what we might call the library of folly. This is the active, systematic, and almost morbid study of failure. While most people are drawn to success stories, chasing the secrets of the latest billionaire, Buffett has always believed that more can be learned from dissecting disasters. He famously quipped, "All I want to know is where I'm going to die, so I'll never go there." This isn't just a clever line, it's a core operating principle. He dedicates a significant portion of his intellectual energy to understanding the specific mechanisms of business and investment failure: hubris, leverage, fraud, misunderstood competition, technological disruption. By cataloging these modes of failure, he creates a mental checklist of red flags, a series of tripwires that alert him to danger long before it becomes obvious to the average investor. He is not trying to find the next big thing. He is obsessed with avoiding the next big blow-up. This focus on avoidance, this deep respect for the power of ruin, is one of the most crucial and overlooked aspects of his genius. A foundational anecdote that perfectly illustrates this principle is Buffett's trial by fire at Salomon Brothers in 1991. This was not an investment he chose, but a crisis he was thrust into, and it provided him with a front-row seat to one of the greatest corporate follies in modern financial history. Berkshire Hathaway was a major shareholder in Salomon, a powerful Wall Street investment bank. In August 1991, a bombshell dropped. A rogue trader at Salomon, Paul Moser, had been systematically submitting false bids in U.S. Treasury auctions to corner the market, a blatant violation of federal law. Worse yet, it was revealed that the top leadership of the firm, including the legendary CEO John Gutfreund, had known about the illegal activity for months and had done nothing. The scandal exploded. The U.S. Treasury banned Salomon from bidding in its auctions, which was a death sentence for the firm. Their clients fled, their credit lines were pulled, and the company was days, perhaps hours, from a catastrophic bankruptcy that could have destabilized the entire financial system. The U.S. Treasury Secretary Nicholas Brady called Buffett in a panic and essentially begged him to step in as interim CEO to save the firm. Buffett reluctantly agreed. He flew to New York and walked into a nuclear meltdown. What he found was a perfect case study in corporate failure. The culture was one of unrestrained arrogance and greed. Traders were incentivized with big swinging dick bonuses to take massive risks with the firm's capital, with little regard for the consequences. Gutfreund's leadership had been passive and disconnected, allowing a cancer of unethical behavior to metastasize. Buffett's testimony before a congressional subcommittee is a masterclass in his philosophy. He didn't make excuses, he laid out the problem in stark moral terms. He famously said, "Lose money for the firm, and I will be understanding. Lose a shred of reputation for the firm, and I will be ruthless." This one sentence encapsulates a lifetime of studying failure. He knew that money can be earned back, but reputation, once lost, is gone forever. He spent the next 9 months cleaning house, firing those responsible, installing new compliance systems, and personally lobbying Washington to restore Salomon's credibility. It was a grueling, thankless job, but the lessons he internalized from that crisis were priceless. He saw firsthand how a flawed incentive system could drive otherwise smart people to do phenomenally stupid and illegal things. He saw how a culture of arrogance was the ultimate blind spot. He saw how quickly a decades-old reputation could be incinerated by a single act of folly. The Salomon Brothers affair became a cornerstone exhibit in his mental library of failure, a story he would tell again and again to his managers and shareholders, a stark reminder of the specific behaviors and structures to avoid at all costs. This deep, visceral experience with failure on a grand scale provided him with a risk management education that no business school could ever hope to replicate. The psychological principle at play here is a conscious battle against two powerful cognitive biases, survivorship bias and the availability heuristic. Survivorship bias is our natural tendency to focus on the winners, the success stories, simply because they're the ones that are still around to be seen. We study the habits of billionaires, assuming that if we copy them, we too will become billionaires. But we ignore the thousands of people who had the exact same habits, the same risk appetite, the same work ethic, but who failed and disappeared from view. It's like looking at the bullet holes in the planes that made it back from World War II. The military initially wanted to reinforce the areas that were riddled with bullets. But the statistician Abraham Wald pointed out the fallacy. They should be reinforcing the areas where there were no bullet holes, like the engines. The planes that were hit in those places never made it back. They weren't part of the surviving sample. Focusing only on the survivors gives you a dangerously incomplete picture of reality. Buffett's obsession with failure is his way of looking for the planes that didn't come back. He actively seeks out the corporate graveyards to understand the true causes of mortality. This is linked to the availability heuristic, a mental shortcut where we overestimate the importance of information that is easily recalled. Success stories are flashy, they make for great headlines, and they are emotionally appealing. They are highly available to our minds. Stories of failure, of the slow, grinding decline of a company like Sears, or the spectacular fraud of Enron, are more complex and less glamorous. We tend to forget them. By deliberately creating a, quote, library of folly, Buffett is making these cautionary tales more available to his own mind. He is ensuring that when he analyzes a new investment, the potential failure patterns are just as vivid and easy to recall as the potential success stories. This creates a more balanced and realistic assessment of risk. Most investors are playing offense. Their minds are filled with visions of explosive growth and multi-bagger returns. Buffett understands that winning in the long run is primarily about playing defense. It's about not making catastrophic errors. His study of failure is the equivalent of a football team spending 80% of its practice time studying the other team's offense. By knowing every trick, every formation, every way the opponent can score, you build a truly impregnable defense. And in investing, a good defense is far more important than a flashy offense. So how can we apply this? The mental model is a two-part blueprint, the pre-mortem and the failure journal. Before you make any significant capital allocation decision, be it an investment or a major business initiative, you conduct a pre-mortem. This technique, developed by psychologist Gary Klein, is brilliantly simple and effective. Step 1. Gather your team or just sit down by yourself and imagine that it is 1 year in the future. Your investment has failed spectacularly. It has been a complete and utter disaster. Step 2. Take 10 to 15 minutes and write a detailed narrative history of why it failed. Be specific. Was our main competitor's response much stronger than we anticipated? Did a key technological assumption turn out to be wrong? Did our management team prove to be inept? Did a shift in consumer behavior render our product obsolete? By framing the exercise in this way, stating that the failure has already happened, you liberate yourself and your team from the natural pressure to be optimistic and conformist. It gives everyone permission to raise uncomfortable truths and potential risks without seeming negative or disloyal. The pre-mortem forces you to confront the potential paths to ruin before you have committed a single dollar. The second part of the blueprint is the failure journal. This is your personal, curated library of folly. Get a physical notebook or start a digital document. Dedicate it to the study of corporate and investment failure. Each time you read about a significant business disaster, Blockbuster, Lehman Brothers, Theranos, you create an entry. I suggest a simple 4-part template for each entry. Part 1. The company and its apparent strength. What did the company do? At its peak, why did everyone think it was a great business? E.g., Blockbuster had a dominant retail footprint in every town. Part 2. The fatal flaw. What was the underlying vulnerability or the key mistake that led to its downfall? E.g., they were wedded to their physical store model and saw streaming as a niche product, completely underestimating the threat of Netflix. Part 3. The key lesson. What is the generalizable principle you can extract from this failure? E.g., failing to cannibalize your own successful business model when a disruptive technology emerges is a fatal error. Part 4. The Personal Rule. How can you turn this lesson into a rule for your own investment checklist? E.g., before investing, I must ask, is there a cheaper, more convenient technology that could replace this company's core offering in the next 10 years? Over time, this journal will become your most valuable investment tool. It will be a catalog of landmines, a detailed map of all the ways you can die in the market. Consulting it before any new investment will dramatically improve your risk management and save you from making the same classic avoidable mistakes. The antithesis of this disciplined study of failure is the growth at any price investor. This is the individual who gets completely swept up in a compelling story, a grand vision of the future, and ignores all the warning signs. They suffer from a terminal case of deal fever. They believe, as the siren song of every bubble goes, that this time it's different. They don't want to look at the boring stuff like debt covenants, cash flow statements, or the fine print in the annual report's risk factors section. They want to believe in the visionary CEO and the world-changing technology. This mindset was the engine of the dot-com bubble in the late 1990s. Investors poured trillions of dollars into companies that had no revenue, no profits, and in many cases, no coherent business plan. They bought companies like Pets.com, which was spending a fortune on Super Bowl ads to sell pet food online at a loss. They bought Webvan, which was trying to build a nationwide grocery delivery infrastructure that was bleeding cash at an unsustainable rate. The stories were fantastic. The potential seemed limitless. But anyone who had studied the history of business failures, who had a library of folly to consult, would have seen the giant red flags. They would have recognized the classic patterns: unsustainable cash burn, a lack of a competitive moat, and a complete disregard for profitability. They would have known that while growth is wonderful, growth funded by an endless fire hose of investor capital with no path to self-sufficiency is a recipe for disaster. The growth at any price investor doesn't have this historical context. They are flying blind, mesmerized by the bright, shiny object in front of them, completely unaware of the cliff edge just beyond. When the bubble burst, these investors were annihilated, their portfolios vaporized, because their entire strategy was based on hope and hype, not on a sober assessment of risk, informed by the study of history. The direct financial connection of building a library of folly is the institutionalization of a margin of safety in your investment process. This concept, originally from Benjamin Graham, is the cornerstone of value investing. It means only buying a security when its market price is significantly below your estimate of its intrinsic value. The study of failure is what allows you to build a truly robust and reliable estimate of that intrinsic value. Why? Because you become an expert at identifying what can go wrong. When you analyze a company, you're not just forecasting its best-case scenario, you're actively stress-testing it against your entire catalog of failure modes. You ask the hard questions. How could this company get blockbustered? What are the Enron-like risks in its accounting? Does the CEO exhibit the same hubris as the leaders of Salomon Brothers? This process forces you to be more conservative in your assumptions. It makes you put a bigger discount on your valuation to account for the inherent uncertainties of the future. This in turn widens your required margin of safety. This isn't about being pessimistic, it's about being realistic. The financial result is a portfolio with a fundamentally different risk profile. You will own assets that have a built-in buffer against bad luck or unforeseen problems. This leads to lower volatility, smaller drawdowns during market panics, and most importantly, the near elimination of the risk of permanent capital loss. A portfolio that avoids a single catastrophic zero is mathematically far ahead of a portfolio that has a few big winners but also a few big losers. Avoiding the big mistake is the most underrated key to superior portfolio growth. Your library of folly is the financial tool that ensures you spend your career sidestepping the torpedoes that sink most ships. The third pillar in this architecture of vicarious learning is the flip side of studying failure. It is the art of cloning the greats. This is the principle of intelligent imitation. Buffett has been remarkably open about the fact that very few of his core ideas are original. His entire investment framework is a synthesis, an amalgamation of the best ideas from other brilliant minds. He often says, "I'm a better businessman because I'm an investor, and a better investor because I'm a businessman." But it's equally true that he's a better investor because he was first a world-class student of other great investors. He didn't try to reinvent the wheel. He identified the wheels that were already working better than anyone else's, and then dedicated himself to understanding the physics of why they worked so well. This process of cloning is not about blind mimicry. It's about deconstructing the thinking of masters, internalizing their mental models, and then applying them with your own unique understanding and within your own circle of competence. The foundational anecdote for this pillar is the story of a young Warren Buffett's discovery of the book that would change his life, Benjamin Graham's The Intelligent Investor. In 1949, at the age of 19, Buffett picked up a copy. It was an intellectual thunderbolt. He would later say that reading that book was like seeing the light. Before Graham, investing for Buffett was a mix of charting, technical analysis, and listening to tips, the typical activities of the outer scorecard. Graham provided something revolutionary, a logical, business-like framework for investing. He introduced the allegorical character of Mr. Market, the manic-depressive business partner who offers to buy your shares or sell you his at wildly fluctuating prices every day. Graham taught that the intelligent investor should ignore Mr. Market's moods and instead use his often irrational offers to their advantage, buying from him when he is pessimistic and selling to him when he is euphoric. Most importantly, Graham introduced the central concept of the margin of safety, the idea that you calculate what a business is worth and then only buy it for a great deal less. This simple but profound idea gave Buffett an intellectual anchor that has guided him his entire life. Buffett didn't just read the book, he absorbed it. He read it so many times he practically had it memorized. He realized that this was the system he had been searching for. His cloning went a step further. He discovered that Graham was a professor at Columbia Business School. Despite having already completed his undergraduate studies, Buffett immediately applied to Columbia for the sole purpose of learning directly from the master. He was the only student to ever get an A+ in Graham's class. After graduating, he even offered to go work for Graham's firm, Graham Newman Corp., for free. Graham initially turned him down, but Buffett was persistent, and eventually, he got the job. For several years, he worked side by side with his intellectual hero, applying Graham's cigar butt approach, finding deeply undervalued companies that had one last puff of value left in them. This entire period of his life was an intense act of cloning. He was downloading Graham's entire operating system into his own brain. Later in his career, he would beautifully integrate this Graham-like focus on price with the philosophy of another great investor, Philip Fisher, who focused on buying wonderful businesses with long-term growth prospects. His partner, Charlie Munger, was instrumental in this evolution. Munger convinced him that it was far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This itself was another act of cloning. Buffett didn't stubbornly stick to Graham's original teachings. He recognized the wisdom in Fisher's and Munger's approach and synthesized it into his own, more powerful framework. His genius was not in invention, but in the intelligent selection and integration of the best ideas from others. The underlying psychological principle that makes this so effective is rooted in our neurology, specifically the mirror neuron system. Discovered by neuroscientists in the 1990s, mirror neurons are a fascinating class of brain cells. They fire not only when we perform an action ourselves, but also when we simply observe another person performing that same action. If you watch someone pick up a cup of coffee, the neurons in your brain associated with that specific motion will fire as if you were picking it up yourself. Your brain is, in a very real sense, simulating the other person's action. This system is believed to be the neurological basis for empathy, social learning, and imitation. When you engage in the deep study of a master investor like Buffett, You are activating your mirror neuron system. You are not just passively reading their words. You are tracing their thought processes. When you read Buffett's shareholder letters and he explains his reasoning for buying Coca-Cola in 1988, how he analyzed its brand power, its global distribution, its return on capital, your brain is simulating that analysis. You are vicariously running the mental patterns he ran. The more you do this, the more you start to build and strengthen the same neural pathways in your own brain. You begin to develop an intuition for what a Buffett-like investment looks like. You start to recognize the patterns of a durable competitive moat or a shareholder-friendly management team, just as a young musician develops an ear for harmony by listening to Bach. This is not a metaphor, it is a biological process of vicarious learning. Cloning the greats is a way to intentionally and systematically train your brain, leveraging its natural capacity for imitation to acquire the time-tested mental models of the most successful investors in history. It's a neurological shortcut to expertise. The applied mental model for this is what I call the Board of Mentors technique. This is a structured way to clone the thinking of multiple masters and avoid being dogmatically attached to just one. It transforms the idea of learning from others into a practical, repeatable decision-making process. Step 1. Select your personal board of directors. Choose 3 to 5 investors or business leaders whose philosophies resonate with you and who have stood the test of time. A typical board might include Benjamin Graham, the quantitative bargain hunter, Philip Fisher, the qualitative growth investigator, Warren Buffett, the synthesizer of the two, and Charlie Munger, the master of multidisciplinary thinking and avoiding stupidity. Step 2. For each mentor on your board, create a one-page dossier. This is a summary of their core principles. For Graham, it would include Mr. Market, margin of safety, and his strict quantitative criteria. For Fisher, it would be his 15 points to look for in a common stock, focusing on things like R&D and sales organization. For Munger, it would be inversion, thinking about a problem backward, and his lattice work of mental models. This dossier is your quick reference guide to their brains. Step 3. When you are analyzing a potential investment, you formally consult your board. You take the investment idea and run it through the filter of each mentor. You literally ask the questions in writing. What would Benjamin Graham say about this company's balance sheet and its current valuation? Would he see a margin of safety here? Then, what would Philip Fisher say after using his scuttlebutt method? What would he learn by talking to the company's customers, competitors, and former employees? Does it have a durable competitive advantage? And finally, what cognitive biases would Charlie Munger warn me about in this situation? Am I falling for some Lollapalooza effect, where multiple factors are pushing me toward a foolish conclusion? This process forces you to look at the same problem from multiple, time-tested perspectives. It prevents you from falling in love with a single aspect of the company. Graham's quantitative rigor might temper Fisher's enthusiasm for a great story. Munger's focus on psychological folly might save you from a situation that looks good on paper but has a hidden human element of risk. By creating and consulting your virtual board, you are systematically cloning the decision-making algorithms of the greats, creating a powerful check and balance system for your own thinking. The antithesis to this intelligent cloning is the archetype of the reinventing the wheel entrepreneur or investor. This is an individual blinded by hubris, who believes their idea, their company, or their moment in time is so utterly unique that all the lessons of history are irrelevant. They see the past not as a source of wisdom, but as a graveyard of outdated ideas. They are obsessed with disruption, but have no respect or understanding for what they are trying to disrupt. We see this constantly in the world of venture capital and startups. Founders with a brilliant technical idea might believe they are too smart to worry about boring things like sales, marketing, or creating a positive company culture. They believe a great product will simply sell itself. They haven't studied the countless case studies of technologically superior products that failed because of poor distribution or a toxic work environment. They are destined to repeat those failures, paying the price for lessons that were already freely available in the library of business history. This investor or entrepreneur is constantly starting from scratch. They are trying to derive the laws of financial gravity on their own. Through painful and expensive experimentation, they see seeking guidance from the models of the past as a sign of weakness, a lack of originality. What they fail to understand is that true originality doesn't come from ignoring the fundamentals. It comes from mastering them so deeply that you can apply them in a new and creative way. As Isaac Newton, a master cloner in his own right, famously said, "If I have seen further, it is by standing on the shoulders of giants." The reinventing the wheel investor insists on standing in a hole, trying to see the horizon. The direct financial connection of cloning the greats is that it gives you access to proven blueprints for identifying asymmetric opportunities. These are investments with a high potential upside and a limited, well-defined downside. The strategies developed by masters like Graham, Fisher, and Buffett are not random shots in the dark. They are the result of decades of experience, refinement, and brutal market feedback. They are time-tested systems designed specifically to find situations where the market's perception of a company is drastically different from its underlying reality. When you apply Graham's net-net strategy, buying a stock for less than its net current asset value, you are using a model that has a historical track record of providing a massive margin of safety and significant upside. When you use Fisher's scuttlebutt method to uncover a durable competitive advantage that the market doesn't fully appreciate yet, you are positioning yourself for years of compounding growth. These frameworks are, in essence, recipes for positive expected value. By cloning them, you stop gambling and start investing with a statistical edge. This directly impacts your stock picking. Instead of chasing stories or trends, you are running a systematic process based on principles that have made people wealthy for generations. This discipline dramatically improves your odds of generating significant long-term capital gains and moves you from the chaotic world of the retail investor to the structured, process-driven world of professional wealth management. You are not just buying stocks, you are deploying capital using the same proven war plans that the greatest financial generals have used to conquer the market. The fourth pillar is the engine that drives this entire learning machine, the habit of voracious and active reading. When asked about the key to success, Buffett famously pointed to a stack of books and said, "Read 500 pages like this every day. That's how knowledge works. It builds up like compound interest." For Buffett, reading is not a hobby, it is the central activity of his job. He spends upwards of 80% of his working day just sitting and reading. This commitment to deep learning from the written word is perhaps the most tangible and transferable aspect of his success. While most of us cannot spend 8 hours a day reading, the principle of making deep, continuous learning a core part of our daily routine is essential. This isn't about passively consuming information, it's about an active process of inquiry, of turning raw data from annual reports, biographies, and industry journals into a coherent, usable latticework of mental models. It is the daily workout that builds the intellectual muscle required to win in the long run. A classic anecdote that demonstrates this principle in action is Buffett's investment in American Express during the great salad oil scandal of 1963. This story is a perfect illustration of how he combines deep reading with on-the-ground investigation to form a clear, independent view. A company called Allied Crude Vegetable Oil, a major customer of American Express's warehousing division, went bankrupt. It turned out they had been perpetrating a massive fraud, securing huge loans against warehouse receipts for tanks of salad oil that were mostly filled with seawater. When the fraud was discovered, the market panicked. Investors feared that American Express would be on the hook for all the fraudulent loans, a liability that could potentially bankrupt the company. The stock price was slashed in half almost overnight. The outer scorecard was screaming, "Sell!" This was a moment of intense fear and uncertainty. What did Buffett do? He didn't panic. He went to work. First, he did the reading. He dove into American Express's annual reports, trying to understand the two core pillars of its business, the traveler's checks and the charge card. He saw that these were incredibly profitable businesses, essentially getting a float from their customers, holding their money for a period of time before having to pay it out. He analyzed the balance sheet to see if the company could withstand the potential losses from the warehousing division. But he didn't stop there. His reading gave him the quantitative foundation, but he needed the qualitative conviction. So he went out and did the scuttlebutt research he learned about from Philip Fisher. He personally visited restaurants and hotels. He talked to cashiers and managers, asking them if they were still accepting the American Express card and if customers were still using it. He went to banks and talked to tellers, asking if people were still buying American Express traveler's checks. The answer, everywhere he went, was a resounding yes. He observed that the scandal, while a huge story on Wall Street, had not dented the trust that ordinary consumers and merchants had in the core American Express brand. He realized that the company's moat, its powerful brand and the trust it commanded, was fully intact. The warehousing division was a peripheral issue. The core franchise was unharmed. Armed with this synthesis of deep financial reading and real-world observation, he made one of the boldest moves of his early career. He invested 40% of his partnership's entire capital into American Express stock. Within a few years, the stock had quintupled in value, earning his partnership a massive profit. This story is the perfect blueprint for his method. It starts with deep reading to understand the numbers and the business model, followed by active investigation to confirm the qualitative factors. This process allowed him to see clarity where everyone else saw chaos, and to act with conviction when everyone else was paralyzed by fear. The underlying psychological principle that makes this so powerful is known as cognitive schema theory. A schema is a mental framework or concept that helps us organize and interpret information. Think of it as a mental filing cabinet. When you learn something new, your brain tries to fit it into an existing folder, or if necessary, create a new one. The more you read, especially across a wide range of disciplines, business, history, psychology, biology, physics, the more schemas you build, and the more interconnected your mental filing system becomes. A person who only reads about investing has a very limited set of schemas. When they see a business problem, they can only frame it in financial terms. But someone like Buffett or Munger, who has read voraciously across many fields, has a vast latticework of mental models. When they look at a business problem, they don't just see numbers on a page. They see the psychological biases that might be affecting its management, a schema from psychology. They see the feedback loops that might lead to a boom or bust, a schema from engineering. They see the evolutionary pressures from competitors, a schema from biology. This ability to draw upon a diverse set of mental models allows them to see the world with a clarity and depth that is unavailable to the narrow specialist. They can recognize patterns that others miss because they have a richer, more complex internal map of reality. Every book you read is another node in this network, another tool in your intellectual toolkit. The compounding of knowledge is not linear, it's exponential. Each new model you learn interacts with all your existing models, creating new insights and new ways of seeing the world. This is the superpower that a dedicated reading habit bestows. So how do we build this habit? The applied mental model is a two-part protocol: the information diet and the active reading technique. First, you must consciously design your information diet just as you would design a nutritional diet. Most people consume an information diet of junk food, social media outrage, sensationalist headlines, and shallow sound bites. To emulate Buffett, you must replace this with high-quality, nutrient-dense information. Here is a sample weekly diet to start with. First, read 110K, the detailed annual report filed with the SEC of a company you find interesting, from cover to cover. This is the single best way to understand a business. Second, read one weekly or monthly industry trade journal. If you're interested in the railroad industry, read Railway Age. This will give you a level of granular knowledge that financial news can't provide. Third, read one business biography or a book on a major business success or failure. This builds your library of case studies. Fourth, dedicate time each day to high-quality financial journalism from sources like the Wall Street Journal, the Financial Times, or Bloomberg. By consciously curating your inputs, you starve the part of your brain that craves noise and feed the part that builds deep knowledge. The second part is the active reading protocol. You cannot read this material passively like a novel. You must attack it like a detective looking for clues. The rule is simple. Never read without a pen in your hand. As you read, you must engage with the text. Step 1. In the margins, summarize the key idea of each paragraph or section in your own words. This forces you to process what you're reading, not just skim it. Step 2. Write down any questions that come to mind. Why did management make that decision? Is this competitive advantage truly sustainable? These questions are the seeds of deeper analysis. Step 3. Actively hunt for generalizable principles or mental models. When you find one, highlight it and write it down in a separate models section of your journal. Step 4. After you finish a book or a report, force yourself to write a single-page summary of the most important takeaways and how you can apply them. This process is hard work. It's slow. But it transforms reading from a passive act of consumption into an active process of knowledge extraction and integration. It's how you build your latticework of mental models, brick by brick. The antithesis to this deep work is the headline skimmer. This represents the information consumption habits of 99% of people in the modern world. The headline skimmer's brain is conditioned by the endless scroll of social media feeds and the rapid-fire graphics of cable news. Their knowledge is a mile wide and a millimeter deep. They might be able to tell you that a certain stock is up or down today, and they might even be able to repeat the shallow narrative the media has attached to that move. Stock X is down on inflation fears, but they have no underlying understanding of the business itself. They haven't read the 10K. They don't know who the company's competitors are. They don't understand its balance sheet or its long-term strategy. Their entire reality is constructed from a mosaic of fleeting, emotionally charged headlines. This makes them incredibly vulnerable to manipulation and market manias. They buy at the peak of the hype cycle, when the headlines are most euphoric, and they sell at the bottom of the panic cycle, when the headlines are most terrifying. Their portfolio is not a reflection of a coherent investment strategy, but a chaotic record of their emotional reactions to the noise of the day. They are perpetually confused, anxious, and over the long run, guaranteed to underperform. They are playing the game on the hardest possible difficulty setting because they refuse to do the foundational work of acquiring deep knowledge. The direct financial connection here is the creation of a durable, informational, and analytical edge. In today's market, with information freely available to everyone, a purely informational edge is hard to come by. But an analytical edge, the ability to process that information more effectively and draw better conclusions, is more valuable than ever. By committing to a rigorous reading program, you are building that analytical edge. You will begin to understand industries and companies at a level of depth that the average investor and even many professional analysts who are forced to cover dozens of companies simply cannot match. You will be able to spot discrepancies between the popular media narrative about a company and the reality buried in its financial statements. You will be able to contextualize a company's current situation within the broader sweep of business history, recognizing patterns that are invisible to those without that background. This edge translates directly into the ability to find mispriced assets and achieve alpha or returns above the market average. When a great company is temporarily punished by the market for a short-term problem, the headline skimmer panics and sells. But you, having done the reading, will understand the resilience of its underlying business and see a rare buying opportunity. This is how superior stock picking is done. It's not about secret tips or complex algorithms. It is about a superior understanding of business reality, an understanding that is painstakingly built, day by day, page by page. This is the ultimate path to beating the market and achieving true portfolio growth. The fifth and final pillar of this learning system is arguably the most difficult, as it requires a level of intellectual honesty that is rare. It is the discipline of the post-mortem, the rigorous and unemotional analysis of your own mistakes. Even if you master the other four pillars, developing an inner scorecard, studying failure, cloning the greats, and reading voraciously. You are still human. You will still make errors. The market is a relentlessly humbling machine. The crucial difference between an amateur and a professional, between someone who grows and someone who stagnates, is what they do after they make a mistake. The amateur ignores it, blames it on bad luck, or hides it in a drawer and tries to forget. The professional puts the mistake on the operating table, dissects it with surgical precision, and learns everything they possibly can from its anatomy. Buffett is a master of this process. He is his own harshest critic, and his willingness to publicly analyze his errors is a key part of the educational legacy he provides in his annual shareholder letters. The foundational anecdote for this pillar is Buffett's own self-described mega mistake, the acquisition of Dexter Shoe Company in 1993. On the surface, it looked like a classic Buffett investment. Dexter was an American shoe manufacturer with a long history, a solid brand, and a consistent record of profitability. Buffett was impressed by the management and the company's durable-looking business. He decided to buy the entire company for Berkshire Hathaway. The price was $433 million. But he didn't pay in cash. He paid with Berkshire Hathaway stock. The deal closed, and almost immediately, things started to go wrong. What Buffett had failed to appreciate was the speed and ferocity with which low-cost foreign competition would decimate the American shoe industry. Dexter's perceived competitive advantage, its moat, turned out to be a shallow ditch that was quickly overrun. The company's profits evaporated, and eventually the business became worthless. Now, many CEOs would have buried this mistake. They would have hidden the failing division's results within a larger reporting segment, or simply never mentioned it again. Buffett did the opposite. He used it as a teaching tool for himself and for his shareholders. In his annual letters, he repeatedly brings up Dexter Shoe as his greatest blunder. He doesn't just say it was a mistake, he explains the anatomy of the error. He admits his analysis of the company's competitive moat was flawed. He misjudged the impact of globalization. But the most painful lesson, and the one he emphasizes most, was the folly of paying with Berkshire stock. He explains that the $433 million of Berkshire stock he handed over in 1993 would, by 2014, have been worth over $6 billion. So it wasn't a $433 million mistake, it was a multi-billion-dollar mistake. This brutal, unflinching public analysis serves a critical purpose. It forces him to fully internalize the lesson. It vaccinates him against making the same type of error again. By refusing to hide from his failure, by dissecting it in the open for all to see, he transforms a costly financial loss into an invaluable intellectual asset that improves his decision-making for decades to come. The psychological principle that makes this so difficult and so necessary is the need to overcome two powerful cognitive defense mechanisms: hindsight bias and the self-serving bias. Hindsight bias, often called the "I knew it all along" effect, is our tendency, after an event has occurred, to see it as having been predictable, even if there was no objective basis for predicting it. When an investment turns sour, our brain conveniently rewrites history to protect our ego. We tell ourselves, "I had a bad feeling about that one," or "I should have seen the red flags." This bias is a catastrophic barrier to learning, because if we believe we knew it all along, then there's nothing to learn. We don't analyze our flawed decision-making process because we trick ourselves into believing we never made a flawed decision in the first place. We were just a victim of circumstance. The second barrier is the self-serving bias. This is our natural tendency to attribute our successes to our own skill and talent, but to attribute our failures to external factors: bad luck, the Fed, market manipulation. When a stock we pick goes up, it's because we're a brilliant analyst. When it goes down, it's because of an unpredictable news event. This bias shields our ego from the pain of being wrong, but in doing so, it prevents us from ever identifying and correcting the flaws in our own process. Buffett's post-mortem discipline is a deliberate, systematic assault on these two biases. It is an act of forced objectivity, A commitment to looking at what he actually thought and did at the time of the decision, not what feels convenient to remember in retrospect. The applied mental model for executing this is the decision journal. This is a technique advocated by Nobel laureate Daniel Kahneman and is one of Reed's the most powerful tools for improving judgment over time. It's a simple, but not easy, practice. Step 1. Before you make any significant investment decision, you open your journal. You write down the date, the name of the company, and the price at which you are buying. Step 2. You write in detail your thesis. Why are you buying this? What do you expect to happen over the next 1 to 5 years? What are the key drivers that will make this a successful investment? Be as specific as possible. I believe the company will grow its revenue by 15% annually for the next 3 years because of its new product line. Step 3. You explicitly list the key risks and the signposts that would tell you your thesis is wrong. My thesis would be invalidated if their main competitor gains more than 5% market share, or if their gross margins fall below 40% for 2 consecutive quarters. Step 4. You record how you feel about the decision and your level of conviction, perhaps on a scale of 1 to 10. Then you close the journal and make the investment. Months or years later, you must schedule a time to review the entry. You pull out the journal and compare what actually happened to what you predicted. If the investment was a success, the journal forces you to see if it was successful for the reasons you originally thought. Maybe you were right for the wrong reasons, which is a form of luck, not skill. If the investment was a failure, the journal provides an unvarnished record of your thinking, completely short-circuiting hindsight bias. You can't say you knew it all along when your own handwriting says the opposite. This process separates the quality of your decision from the quality of the outcome. Sometimes good decisions lead to bad outcomes, and vice versa. The decision journal allows you to focus on improving your process, which is the only thing you can control. It is the ultimate tool for honest self-assessment and continuous learning. The antithesis of the disciplined postmortem is the doubling down gambler. This is the investor whose ego is so deeply intertwined with their market positions that they are psychologically incapable of admitting a mistake. When they buy a stock and it starts to fall, they don't see it as evidence that their initial thesis might be flawed. They see it as a personal attack, a sign that the market is wrong. Their cognitive dissonance becomes unbearable. To resolve it, instead of admitting their error and selling the position to cut their losses, they do the opposite. They double down. They buy more of the falling stock, averaging down their cost basis. Their thought process is not analytical, it is emotional. It is driven by hope and a desperate need to be proven right. They turn what could have been a small, manageable loss, a tuition payment for a market lesson, into a catastrophic portfolio-crippling disaster. This behavior is incredibly common. The gambler never conducts a post-mortem because they never admit the patient is dead. They keep trying to resuscitate a failed idea, throwing good money after bad, until they have nothing left. Their refusal to learn from small mistakes guarantees that they will eventually make a fatal one. It is the ego-driven path to the poorhouse. The direct financial connection of a rigorous post-mortem process is the systematic elimination of leakage from your investment returns and the continuous improvement of your future results. Think of your investment strategy as a boat. Every unexamined mistake, every repeated behavioral bias, is a small hole in the hull of that boat. Individually, they might seem minor, but over time, they cause the boat to sit lower and lower in the water, slowing it down and making it vulnerable to sinking in a storm. A post-mortem, using a tool like a decision journal, is how you find and plug these leaks. When you analyze a failed investment and realize the root cause was your tendency to overestimate a company's growth prospects, you can build a new rule into your process. A more conservative check on growth projections to plug that specific leak. When you analyze another mistake and find it was caused by panic selling during a market downturn, you can strengthen your resolve by referencing your investment policy statement, plugging that leak. Each mistake, when properly diagnosed, allows you to patch a hole, Over an investing lifetime, this process transforms your leaky boat into a watertight vessel. This has a direct and powerful impact on your financial freedom. It means that the quality of your decision-making is constantly improving. Your future rate of return will be higher because you are systematically eliminating the sources of unforced errors. The capital gains you generate become more consistent and reliable. This isn't just about making more money on your winners. It's about losing less money on your losers, which is often the more powerful driver of long-term wealth management. Each mistake, when subjected to an honest post-mortem, ceases to be a liability. It becomes an asset, a piece of scar tissue that makes you stronger, smarter, and ultimately, a more successful investor. You have just spent this time absorbing a system, a blueprint for how to think, not what to think. We have deconstructed the 5 core pillars that allowed one man to turn a small partnership in Omaha into a global financial fortress. You learned about the inner scorecard, the psychological armor needed to ignore the madness of the crowd. You learned to build a library of folly, to become a student of failure and learn from the costly mistakes of others. You learned the art of cloning, of standing on the shoulders of giants to see further than you could on your own. You learned that reading is not a pastime, but a superpower that compounds knowledge. And you learned the critical discipline of the post-mortem, of turning your own inevitable errors into your most valuable lessons. Together, these 5 pillars form a powerful mental machine for accelerating your learning curve, for downloading decades of experience without paying the devastating price of trial and error. You have acquired a tool that can fundamentally change your relationship with risk, with decision-making, and with the very process of building wealth. But it is crucial to understand what you have just been given. This is not the entire map. It is a single, incredibly detailed and powerful section of that map. The system of thinking that Buffett and his partner Charlie Munger have built is a vast, interconnected latticework of mental models. The principles you've mastered today are the foundation, but they are designed to connect to other, equally powerful concepts that govern valuation, competitive analysis, and behavioral psychology. You have built the engine, but to truly navigate the complex world of modern finance and executive decision-making, you need the chassis, the transmission, and the guidance system. You have learned how to learn, but the journey of learning is endless. And that is the journey you are on. The very fact that you have watched this far proves you are not a headline skimmer. You are part of a small minority committed to the deep work required to achieve true financial sovereignty. And now, at this exact moment, the algorithm is presenting you with a choice. On your screen is a suggestion. It may seem random, but it is not. It is the next piece of the map. It is the link that connects the principles you've just learned to another critical node in the network of wisdom. It might be a deep dive into competitive moats, a case study on capital allocation, or an exploration of a specific cognitive bias. I don't know what it is, but I know that it is the next logical step. The path of the 99% is to click away, to seek distraction, to let this new knowledge fade. The path of the serious student, the future master of their own financial destiny, is to see this not as another video, but as the next chapter. The choice is yours. Will you complete your mental arsenal? Will you continue the ascent? The next piece of the map is waiting. Click and continue the journey.